Welcome to Corporate Finance. In problem 8.1, we have RLX company just paying a dividend of $3.20 a share, will grow at a constant rate G of 4% per year. Investors require a 10.5% return. What is the current stock price? So your R is 10.5%. What's price today? P0, price in 3 years, price in 15 years. So our constant dividend growth formula is P sub T equals D sub T plus 1 over R minus G. Therefore, plugging in a 0 for T, I get D1 over R minus G. D1 is equal to D0 times 1 plus G, 1 year out at that constant growth rate, divided by R minus G. And then P3 is P0 times 1 plus G to the third, or P4. Yeah, P3 times 1 plus P0 times 1 plus G to the third is P3, and then P15 is simply that same price at today, P0 times 1 plus G to the 15th. So there are a couple ways to calculate this. P3 then is equal to D4, similar to P0 being equal to D1 over R minus G. P3 is equal to next dividend over R minus G, and that's equal to D3 times 1 plus G to get D4 over R minus G. Or I can take D0, today's dividend, times 1 plus G to the fourth to get to D4. Similarly, P15 equals D16. Price today equals next dividend over R minus G. So using the math here for P0, I get D1 over R minus G. D0 being 320 because it said just paid. If it said next dividend, that would already be D1, and we just plug it in. But since it says just paid, I got to take it out 1 year. So D0 times 1 plus G over R minus G, I get $51.20. For P3, that's equal to D4 over R minus G, or it's also equal to P0 times 1 plus G to the third. So 2 ways to calculate. This is using the price, and then basically it's chapter 5 all over again. And then, so I took, in the second one, I took today's stock price, P0, 5120 times 1.04 to the third. And for this one, P15, I took today's stock price times 1 plus the growth rate to the 15th to take it out 15 years, 92.21. I can also calculate this by saying that P3 is equal to D4 over R minus G, and P15 is equal to D16 over R minus G, and I get same answers. Should get same answers whether I just compound the price like I did up above, or if I take the next dividend over R minus G. Same answers should arise for P3 and P15. In problem number 8.2, I see that M Inc.'s next dividend, D1, equals 1.87 per share, 4.3% G forever. Stock sells for $37 a share today. What's the required return? 2 components of required return are dividend yield plus capital gains yield, G. So I simply take dividend yield, which is $1.87, divided by 37. D1, don't have to multiply by 1 plus G because it's already the next dividend. D1 over today's stock price plus G of 0.043, and I get an answer of 9.3541%. In problem 8.3, we want to know what's the dividend yield, what's capital gains yield. So dividend yield is just D1 over P0. Capital gains yield is just G. So I can break that answer to problem number 2 into 2 pieces. D1 over P0 is $1.87 over 37. I get 5.054%. And G is just G, 4.3%. And I should be able to add both of them up and get the same answer as in problem number 2. So 5.0541 plus 4.3 is 9.3541. Check. Checks out with problem number 2. There are your answers to problems 1, 2, 3. In problem 8.45 star, we'll pay a 3.0 for dividend, $3.04. Dividend next year. We'll increase that dividend constant G of 3.75% per year indefinitely. Your required return R is 11%. What is the price of the stock today using the constant dividend growth formula? P0, today's stock price equals next dividend over R minus G. So I get then 3.04 is my D1 next dividend. No need again to multiply by 1 plus G because it's not D0, it's D1 given to you. I'm going to divide by R minus G, 0.11, quantity 0.11 minus 0.0375, and I get a final stock price today for 5-star corporation of $41.93. Kakamisi Company will maintain a 3.4% growth rate of dividends indefinitely. That's your G. Dividend yield is 5.3%. So we want to know what is the required return. Required return is D1 over P0 plus G. So my D1 over P0 is 5.3%. I add that to my G of 3.4% and I get 8.7% for problem number 5. And in problem number 6, a company's stock sells for $78 today. Required return is 10.9%. The total return is equally divided between D1 over P0 and G. So what is the current dividend? The two components of required return equation. My required return is equal to dividend yield plus capital gains yield. In this case, my total return of 10.9% is equally divided between D1 over P0 and G. So each of those is equal to 5.45%, dividing that 10.9 in half. And then we can say that 0.0545 equals D1 over 78. And I get my D1 then, calculating quickly, of $4.25, 0.0545 times 78. And to go back 1 year to D0, what is the current dividend? D0, not D1. I divide that D1 by 1.0545 and I get a D0 of 4.0313. There's your answer to problem number 6. Number 7, Haley Corporation pays a constant 945 annuity type of dividend for 13 years. Then it stops forever. If your required rate of return is 10.7%, what is P0? So this looks like an annuity to me. So the present value of that annuity, it's a 13-year annuity, is C times 1 minus 1 over 1 plus R to the T, all of that over R. So there's your annuity PV formula from Chapter 6. Today's stock price then is equal to $9.45. That's your constant cash amount or dividend times 1 minus 1 plus 0.107 to the 13th power, all of that bracketed over 0.107, and I get a stock price of $64.76. The alternate way I could calculate that would be to take $9.45, each individual dividend, and discount it back to today 13 times. So I take $9.45 over 1.107 plus $9.45 over 1.107 squared plus $9.45 over 1.107 cubed, $9.45 over 1.107 to the 13th. Should give you the same answer, $64.76. The present value annuity way of doing it is more efficient and effective given that you've recognized it's an annuity, and it avoids many, many problems. You might make 14 errors doing it the longhand way, discounting each cash flow back 13 times and then adding them together, whereas you might make one error doing this one longer formula, which is more compact. Present value annuity formula once you realize it's an annuity. Fegley Inc. has an issue of preferred stock that pays $3.80 per year in perpetuity, sells for $93 a share. What's the required return? Now, since it's a perpetuity, that's C over R, present value from Chapter 6. Present value perpetuity is D over R, C over R. So I just take that dividend divided by today's stock price, and I get required return of 4.0860%. There's your answer to problem number 8. And in problem number 9, you have red, yellow, and blue corporations. We each pay a dividend of $4.15 a year next year. That's D1, so that's the next dividend. The growth rate in dividends is 4% per year. That's your G. The required return is 8% for red, 11% for yellow, and 14% for blue corp. What's the stock price? So again, I'm going to use the constant dividend growth equation, because the growth rate G is given at 4% per year. So I simply take D1, dividend 1 of $4.15, and divide that by 0.08 minus 0.04, R minus G, and I get $103.75. For Yellow Corp, I do the same thing, but I take 0.11 minus 0.04, and I get $59.28. And for Blue Corp, I do the same formula, and I get an answer of $41.50. So you see that as my required return gets higher from red to yellow to blue, my stock price goes down accordingly. There are your answers to problems 7, 8, 9. In problem 8.10, we have Cornwall Enterprises with 720,000 shares outstanding. Stock sells for $48 a share. Straight voting. It's important. What will it cost you to buy a seat? So the equation is 50% of the outstanding plus one share, and then multiply that by $48. So I want to take half of the 720,000, 360,000 shares plus one share, 360,000 and one share times $48 a share, and I get $17,288,048. This is important if you're in an acquisition mode and you want to buy a company. You have to find out if they use straight voting or cumulative voting, and if it's straight voting, it's half the shares plus one share. If it's cumulative voting, like this company, Cornwall now is using cumulative voting. 4 seats are open for election. What is the cost now if you want to guarantee yourself a seat on the board? It's 1 over n plus 1. Turn that into percent plus one share. So 1 over 4 plus 1 is 1/5, or 20%. Turn it into a percent plus one share. So I take 20% of the 720,000 shares outstanding and plus one share. 20% of 720,000 is 144,000 at $48 a share plus an additional share. So I would need to spend $6.912048 million to guarantee myself a seat on the board of directors. And in number 12, we have Dahlia Flower Company with earnings per share of $3.64 per share. Price to earnings ratio is 18 times. And what is an appropriate stock price for this company? What if the PE is 21? So if the PE is 18, I take earnings per share times price to earnings. Earnings cancel out, and I get a price per share of $65.52. 364 times 18. At a PE of 21, the stock price goes up to $76.44 per share. And there are your answers to problems 10, 11, and 12. Problem 8.13. Z-Space has sales of 2.7 million. Their price to sales ratio is 4.3 times. What's an appropriate stock price if there are 175,000 shares outstanding? And if the price to sales ratio is 3.6 times. So 4.3 times will be one case, 3.6 times will be the second case. So the stock price today at 4.3 times is simply sales per share times 4.3, and I would simply multiply 2.7 million divided by 175,000 to get sales per share times 4.3, and I get $66.34. And for the 3.6 times case, I get the same number times 3.6, or $55.54 per share. Now problem number 14. Chinua Farms just paid a $2.95 dividend. The growth rate G is 3.4%. Investors require a return of 15% for 3 years, 13% for 3 years, then 11% thereafter. What is the current stock price? Again, in this case, this gets more complex, one of the more complex methods of valuing a stock, and that is the wildly fluctuating stock valuation equation. Draw myself a timeline of dividend D0 at $2.95, and then it's going to grow 3.4% per year all the way out going forward. And so where do I stop and where do I start? So first I start at P6, and that's the point where the R's change. They go from, required returns go from 15% for 3 years down to 13% for 3 more years. Then they finally change to 11% after the 6th year. So I go out there and calculate price 6, which takes into account all those dividends beyond year 6. So P6 equals D7 over R minus G. D7 is D0 times 1 plus G to the 7th over R minus G. So I first calculate P6, filling in the numbers, $2.95 times 1.034 is my constant G to the 7th over R minus G, 0.11 minus 0.034. In this case, I'm using the 11% required rate of return out there in year 7, and I get a stock price P6 of $49.05. Then I step back and calculate P3. P3 is simply D4 over 1 plus R plus D5, that's 2 years out, over 1 plus R squared, plus D6 over 1 plus r cubed, because that's 3 years from P3, plus P6 over 1 plus r to the third. P6 I just calculated above at 49.0515, and I get a P3 stock price of $42.21. And then from there I step back and calculate P0. P0 is equal to D1 over 1 plus r plus D2 over 1 plus r squared plus D3 over 1 plus r cubed plus P3 that I just calculated in the cell above over 1 plus r cubed. In this case, I'm using a required return of 15%, you notice in the equation. So I then get a final stock price P0 of $34.93. In problem number 815, Metallica Bearings pays no dividends for 9 years, then all of a sudden $14 in year 10 plus 3.9% growth per year thereafter. The required rate of return is 11.5%. What is the current stock price? So the stock price today is equal to D10 divided by 1 plus r to the 10th, bringing that 10th year dividend back, and then plus P10 divided by 1 plus r to the 10th, where P10 is equal to D11 over r minus g. So I can do this several ways. I should still get a stock price of $69.16. The way I did it in this case is equal to, I did the longhand way, which was D10 over 1 plus r plus P10 over 1 plus r to the 10th, and I get an answer of $69.16. I also can look at calculating P0 as being P9 divided by 1 plus r to the 9th, and I get an answer. First I have to calculate P9, and what is P9? It's D10 over r minus g, which is $14 over 0.115 minus 0.039. That gives me a P9 of 184.21. And then discounting that back to today, 9 times, I get a stock price today of $69.16. Same answer I got using the longer hand method. There are your answers to 13, 14, and 15.